Hello and welcome. Today, in a discussion brought to you by the experts over at My Tax Accountant, we're going to be talking about a really vital piece of UK estate planning, the spouse exemption for inheritance tax. We'll get into how it works and, crucially, a major change that's coming in 2025 that you absolutely need to have on your radar. I mean, it's something a lot of us think about, right? The big worry is pretty straightforward. How do you make sure that everything you've worked so hard to build together goes straight to your spouse, without a massive slice of it being taken for inheritance tax? Well, thankfully, there's a specific rule designed to do just that. Okay, so before we can really appreciate the exemption, we've got to quickly get our heads around the tax it helps you avoid: inheritance tax, or IHT for short. So what is it really? Think of it like this. It's a tax on the total value of, well, everything you own when you pass away. But, and this is a really big but, it doesn't apply to every single estate. It only actually kicks in if the value of your estate goes over a certain line in the sand drawn by the government. And when it does kick in, the rate is a pretty hefty 40%. Now, I know that number can definitely make you sit up and take notice, but just remember that standard rate is only charged on the part of your estate that's over the tax-free limit. So for the 2025-26 tax year, that tax-free amount is £325,000. This magic number has a name. It's called the nil-rate band. Anything you own up to this value can be passed on completely tax-free. It's only the value above this that the 40% rate starts to look at.
So how do we shield our estate from that big 40% tax hit? Well, for anyone who's married or in a civil partnership, there's a fantastic, really powerful tool for this. It's called the Spouse Exemption.
And honestly, the rule here is just so powerful in its simplicity. Any assets that you pass to your legal spouse or civil partner are 100% exempt from inheritance tax. It doesn't matter if you're passing on £500,000 or £50 million. It's totally exempt. So let's break that down. The big takeaway, it's unlimited in value, and it even covers gifts you make to each other during your lifetime. But, and this is a really important but, it comes with a very strict condition. It only applies if you are legally married or in a civil partnership. Unfortunately, if you're cohabiting or long-term partners, you don't qualify for this. Okay, so up to now, it seems pretty clear, right? Well, hold on, because this is where things are about to get really interesting. And frankly, it's why we're talking about this right now. A massive change is coming into play from April 6, 2025, and it could easily catch people out. You see, the government is basically saying, you know that old super confusing system based on something called domicile? Yeah, we're throwing that out. And they're replacing it with a much clearer time-based residency test. Now, this should make things simpler to figure out, but it could also be a lot stricter, especially for international couples.
So here it is, the new rule in a nutshell. Starting in April 2025, to get that full, unlimited exemption, there's a new condition. Both you and your partner must have been UK tax residents for at least 10 of the last 12 years.
And that just brings up a huge question, doesn't it? What if one of you is an international citizen? Or maybe you've worked abroad for a few years, or you've just moved to the UK recently and you don't meet that 10-year requirement. What happens then? Well, the consequence is significant. If just one partner fails that residency test, that unlimited exemption is just gone. Instead, it gets capped at the standard £325,000 nil-rate band, and that means any value above that could all of a sudden be facing a 40% tax bill. And this change has very real-world impacts. Let's put this into context. Take the case of Raj, a business owner who's been a UK resident for 6 years. He just assumed that being married meant a full tax-free pass for his wife, who's been a UK resident her whole life. But under these new rules, you can imagine his shock when he discovered that only the first £325,000 of his estate would actually be protected. So yeah, that new rule can feel like a bit of a minefield. But the good news is there are ways to navigate these changes and steer clear of the common traps. Let's talk about some key strategies. You see, the spouse exemption isn't the only tool in the box. There are other really powerful allowances and reliefs you can use. Things like being able to transfer unused allowances, and even specific reliefs if you own a business or agricultural property. Now, one of the most brilliant concepts is the transferable nil-rate band. Basically, if the first spouse to pass away doesn't use up their full tax-free allowance, the surviving spouse can claim what's left over. When you combine that with other reliefs for a family home, a couple could potentially pass on up to £1 million completely tax-free.
And for business owners, people just like Raj, this next one is an absolute game changer, especially if that spouse exemption is now limited. It's called Business Property Relief, or BPR. And this relief can slash the value of your business assets by 50 or even 100% for tax purposes, which could potentially wipe out the IHT bill on the business altogether.
Okay, so with all that in mind, what should you actually do now? Especially with that 2025 deadline getting closer and closer. Here's a simple, actionable checklist you can follow to see where you stand. First up, the easy one, confirm your legal status. Then, and this is the big one now, you've got to check the residency history for both you and your partner against that new 10-year rule. Next, get a really clear valuation of your estate and definitely review your will to make sure it's up to date. And always make sure any transferable allowances get claimed. And finally, look, this stuff gets complicated, so getting expert advice is absolutely key. Which really leaves us with one final, crucial question to ask yourself. This shift from that old domicile system to a strict 10-year residency test is a fundamental change. So are your plans ready? It's really essential to review everything now, just to be sure that your family, your business, and your assets are all properly protected. Because every single family situation is unique, right? So getting advice that's tailored specifically to your circumstances is just crucial for your peace of mind. For that exact kind of expert guidance, you can reach out directly to the team at My Tax Accountant. They're available to discuss your situation via WhatsApp, on the phone, or by email. Thanks so much for joining me.